Choosing between XEQT and VEQT isn't about the 0.04% tiny fee difference you've likely heard about. The real choice actually comes down to one key question, and that's, are you building a Formula One car for maximum speed or a performance SUV for all-weather stability? Answering that question is the key to building an entire portfolio with just one click. And in the next 5 minutes, I'm going to give you the accountant's final verdict so you can get started. All right, let's tackle the fees part first because that is what everyone asks about. First, we have XEQT from iShares, and that has a management expense ratio, or MEF for short, of 20 basis points. The next option people ask is VEQT, which has a slightly higher management expense ratio, or MER, of 0.24%. Now, what does that tiny little 0.04% or 4 basis points actually mean for your wallet? Let's be practical accountants about this. At $10,000 investment, you're looking at a fee difference between the two funds of only $4. And at $100,000, that's only $40 a year. So what's my verdict on the fees? Well, technically speaking, XEQT wins, no doubt about that. But that difference is so small that you should not let it be a deciding factor whether you go with XEQT or VEQT. And if that's the case, then what should be your deciding factor? Well, let's talk about that. The real meaningful difference and what you should be focusing on is how each of those funds chooses to invest your money right here in Canada. This is a concept known as home country bias. With XEQT, about 25% of the fund's portfolio is invested right here in Canada. And compare that to VEQT, it has a slightly higher investment in Canada, and it chooses to invest up to 30% of the entire portfolio in Canada. The strategic question you have to ask yourself is this: do you want and do you believe in having a higher stake in your home country where you work, where you play, and where you might ultimately retire? Do you want that extra 5% exposure to your home country, Canada? And let me be very clear about this. There's no single correct answer to this question. The right answer is whatever best fits your journey. And to give you a hint, because I don't want to leave you hanging, both of these funds have delivered an annual rate of return between 12 to 13% since they launched. Point is, even that 5% difference between the two of how much to invest in Canada is not and should not be a deal breaker for you. It doesn't make that much of a huge difference when you look at the one important key factor, and that's what you should really care about, is total return. Let's start off with our first scenario, the young accumulator. This is someone in their 20s or their 30s, and they are investing for the long haul. And when I say long haul, I mean decades, not years. And their go-to option for this investment is their TFSA. Your number one goal here is growth. This is a long journey. It's an open racetrack with decades to go. You know that you can handle the extreme speed and bumps along the way because your finish line is still far away. You are building a Formula One race car here, and the engine is your 100% equity ETF. Or maybe you're getting closer to retirement. You've been on that racetrack for a while. You've done the few laps. And now your mindset and your goals are shifting from growth to wealth preservation. For this next leg of your journey, you now need a performance SUV. And these fund companies have a solution for you. It's called XGRO or XGRO or VGRO, VGRO. And how do they differ from VEQT and XEQT? Well, those funds are about 100% equity. We're not looking at 80% equity and 20% allocation to bonds. That 80% stock allocation, that's still your very powerful massive engine. But then what's the point about that 20% in bonds? That's your all-wheel drive system. It's what gives you your stability and traction when the road gets a little bit slippery. And ultimately, it ensures that you get to your final destination in style, in comfort, and most importantly, you arrive safely. The point I'm trying to make here is that it's not about having just one vehicle for the rest of your life. Smart investors know when to swap out their F1 car for that performance SUV when that finish line of retirement gets closer. There is no better way to see this in action. Let's go with a real-world example when it comes to saving for your child's RESP. When your child is young, you can be a little bit more aggressive with that F1 car. You can go with 100% XEQT or VEQT, that 100% equity engine. But as your child gets closer to needing that money for education, that's when you need to de-risk. So for, let's say, ages between 15 and 17, you might sell half of your XEQT or VEQT, and you might swap in the XGRO or the VGRO. What that does, it reduces your 100% equity allocation to now 90% equity allocation and 10% into bonds. And once they turn 18 and they're ready to go to college or university, you can be 100% in that SUV. You can go with XGRO or VGRO and still have that 80% equity allocation engine, but that 20% bond allocation, that's your stability. That's your all-wheel drive system kicking in. And that right there is to protect your money for when you need it. And this exact same concept of de-risking that we just looked at also applies to your retirement. And XGRO and VGRO are not the only options. There's an option for 60% equity and 40% bonds, 40% equity and 60% bonds, 20% equity and 80% bonds, and so on. The choice and the car you choose to drive when, that's the choice you want to make. The real choice isn't just XEQT versus VEQT. The real choice is, when do you need that F1 car? When do you need the performance SUV? And maybe you need a family sedan, or maybe you need a minivan, right? Knowing what vehicle to choose when, that's the real choice. Now I have to put my accountant's hat on for a quick second, because there's two money related questions that always come up every time XEQT and VEQT are mentioned about being placed in a TFSA. The first question is about a tiny little tax leak called the foreign withholding tax. Because these ETFs hold thousands of stocks in the US market, the international market, the dividends from these companies that are within that ETF get hit with a 15% tax even before those dividends have a chance to get to the fund itself. For a growth portfolio, this tax leak is very tiny. It does not matter in the grand scheme of things. This should not be a reason for avoiding this strategy. In fact, the cost of inaction is actually higher. The second money question I get is about fees. Now, we've already covered that the MER difference between the two funds is minuscule at best. But what you save by using these ETFs, doesn't matter which one, is huge nonetheless. Why? Because you're completely avoiding foreign exchange fees. And these fees can range from 1.5% to 2% every single time you buy a US stock or US ETF directly. This is massive, and this is often overlooked by many investors, and it could secretly be costing you thousands of dollars over time. So make sure to take a look at these fees. Are you unknowingly paying these foreign exchange fees? If you are, then you need to double check your investments. Now, throughout this video, I've been giving examples about XEQT, XGRO, VEQT, VGRO, and some of you sharp enough paying attention are going to go to the comments. Well, what about ZEQT? What about FEQT? What about HEQT? What about some other random letter plus EQT? Whether you're considering different options from Fidelity, Horizons, BMO, doesn't matter. Those are effectively different manufacturers for the same type of car. Whether you choose a Ferrari, whether you choose a McLaren or the Porsche, at the end of the day, you're still choosing a Formula One car for maximum speed. The type of vehicle you build is infinitely more important than that badge on the hood. They're all excellent choices, so it doesn't matter which one you choose, it just comes down to preferences. And having said all that, that is still no shortcut for not doing your due diligence. You still have to check under the hood, what's the MER ratio? How much is the allocation to Canada versus the rest of the market? Are there any bonds? So make sure you do your own due diligence before you choose your car. And that goes for even buying a car. You're not just going to go to the dealership and pick a car. You have to figure out and do your diligence on the right car for you. So at the end of the day, as you can clearly see, the decision isn't really about choosing XEQT versus VEQT. It's a strategic decision, really about your own personal finance journey. The most important thing you can do after you do your analysis on which car is right for you is to take action. Like I said, the cost of inaction is far higher than anything else. The biggest risk isn't about choosing the wrong fund. It's about never getting out of the garage in the first place. So I want to hear from you. Which vehicle are you building for your personal finance journey? So let me know in the comment section down below. Are you building that F1 car for maximum speed? Or are you preferring that performance SUV for all-weather stability. If this video helped you make a more confident decision about which car you choose, then do me a quick favor, hit that like button and subscribe for even more practical personal finance content. Thanks for watching. I'll talk to you in the comments section.